Good morning, everybody. We are going to get started here in just a minute. Hope you guys can hear me okay. Good morning, good morning. Yep, we're going to get started here in just a minute. I'm going to give people just another little bit here to log in. We've got some important points to go through this morning. Okay. All right, we're right at the top of the hour here. Good morning, everybody. Happy Thursday. Just quickly making sure you guys can hear me. If you could let us know quickly in the little chat room, chat box there, if you guys can hear me, that would be fantastic. And I'm going to make this window here a little bit smaller so that you guys can actually see my screen, which of course is what matters more here than anything else. So let's get started here. And like you do actually have to use the chat box here on YouTube, not like our Slack chat room, if you're going to respond to that message. Anyway, I know technology can be confusing. So here we are. I've got a few, I think, really important points, in my humble opinion, of what really to focus on. So first of all, here is the conversation that I had this morning with a hedge fund client this morning in London. And the conversation doesn't start with U.S. equities. It starts with what's the currencies doing, right? And so what I would like to do is I want to quickly share with you the equity market, because I understand that's what all people care about, sadly, because it's not the driver. But I'll show you so you have some idea. So U.S. equities, if we look at the futures market here, are up about 1.5% for the S&P. We will see how long that lasts. I'm not quite sure that's going to last a hell of a lot longer, but we shall see. But really, I think what I'd like to do here for the next 10 minutes or so is build a little bit of perspective of what, in our review, is actually the driver here. Now, if we broaden our horizon a little bit and we look away from NVIDIA and S&P 500 futures and NASDAQ futures and the Mag 7s, wherever, we need to understand what's actually driving all this. And so there's a couple things that are happening that are, I think, really important. So first of all, let's bring up this chart here, and I think this chart should be more than telling of what exactly is taking place here. So what you have here at the top is the U.S. dollar. Sorry, actually, I did this wrong. I need to show you this here. My apologies. Let me get this chart right here, and then I'll show you I changed my chart before so I could show you all this, and then I messed it up. All right, here we go. Here we are. So what we need to understand is that this rally that we're seeing here in the equity market, so this is the S&P 500, we could make this the futures market so it reflects today's price action. I understand everyone just cares about that. But really all that's happening is that we're devaluing the dollar here with these rate cuts. So the dollar, which is our purchasing power, right? Most of us get paid in dollars if we're U.S. based, if we're or in other places, of course, different currencies. But what's been happening here is that we've been devaluing the dollar. So our purchasing power has actually gone down. That is the purple line. So if you're getting very excited about your equity portfolio being up this morning, if you're long equities, understand that the currency market, the dollar, and the dollar is actually not as bad anymore this morning as it was earlier, but the currency market is basically fluctuating the equity market higher, or floating the equity market higher. And if you're wondering if there's other things that are higher in the back of this, like gold. Gold is up too. Now gold is this line up here, and that's really dumb that this is the same color. So let me make this a different color. Very silly in my part. My apologies. Let me make this a green color. All right, there you go. So it's not just stocks that are up. It's gold is up actually as well. In fact, gold futures are now up. Actually, not as much. The equities are definitely outperforming. But my big thinking here this morning, after all the conversations I've already had this morning and yesterday after the Fed, is that we are witnessing a lot of initial reactions on the part of algorithms that are basically moving this market higher. So as I was talking to JB, John Brunel, my analyst this morning, and we were discussing this, and one of the things that I noticed watching the futures market overnight is that it all kind of emanated out of Asia. So obviously yesterday the U.S. equity markets during U.S. equity hours had sold off, but then the algos, some other algos picked up that this was dovish. It was a dovish sort of rate cut yesterday, and that would somehow be bullish for long duration risk assets. And ultimately that's probably true. The question is that really the case in the near term? I highly doubt it is, and so I think this is going to fade pretty soon. But I also don't want to disrespect it, right? I think we need to be careful here, and we'll look at the gap trade. For those of you guys that are Inner Circle members, we will see you guys in the gap chat room later, where I think we'll have we'll see, but I think we have a pretty good setup at a gap trade this morning, so we'll watch that closely. So that's that. The other thing I want to point out is, and this is probably the bigger message than anything I've mentioned so far, is when you scan the headlines and you look at the major financial media over the past 12 hours, let's call it, I cannot find a single person that's talking about maybe the reason for the rate cut wasn't because unemployment's is getting horribly bad, or because inflation's coming down, which is a lot of the excuses, but because we have to because we have to understand that we have a huge debt wall due. Okay, and so to give you a little bit of an understanding on this, I'm going to show you this chart here. So this here is literally an absolute giant wall or mountain of debt that is going to have to be refinanced. So what the Fed has to do is they have to lower the short end of the interest rates as much as they can, so that our debt burden, which is already, I think, the second biggest expense on the budget line, doesn't go like even crazier and completely spin. It's already out of control, but like way out of control, right? So they have to get essentially in front of this massive debt mountain that has to be refinanced. I'm shocked that the financial media isn't talking about this, but I'm also not, because typically this is not what's going to get clicks, right? You think about the financial media and you think about what gets clicks, that's what the reason is. It's because they have to do something that people can actually understand or care about. No one cares about this. It's not even an issue anywhere. I mean, it is a massive problem, but no one really seems to care about it, and it's not going to get much clicks, right? But if people talk about, inflation's coming down or unemployment, that's something that people tend to listen to better than this. But this, to me, is actually the absolute main reason why they're cutting 50 basis points. They have to get ahead of this so that they can actually get sort of the refinancing of the debt in control, right? Now, let me say one more thing, and I think this is important because we do want to watch the dollar here. Just going back to the other point from before. So I'm going to get rid of all this stuff and just look at the dollar index, which is the dollar index, essentially the vast majority of it is basically the euro versus the dollar and the yen versus the dollar. So it's basically those two pairs are basically what makes up the vast majority of the dollar index. One thing that I think is also really important to keep in mind is the more the dollar falls here, the more at some point there's actually a risk of the equity market unwinding. And it's not happening until it happens. And by the way, I have one stock I want to give you guys as well today. So today there's a whole bunch of things that I actually like, that I would like to give you as an idea. If you are a foreign holder of U.S. equities, like let's say a major central bank which owns the Max 7 stocks, or a big fund or something like that, and currently there's a record amount of foreign holders of U.S. equities. It's about 20% of U.S. equities are being owned by foreign investors, big investors, not forget the small ones, but the big ones. Now these investors typically have a different currency. That's their mother currency, but they invest in dollars, and those are unhedged dollars. Stay with me. This I think is actually super important. If the dollar continues to drop here, at some point, these investors are no longer making money on those dollar-denominated tech stocks. They're already no longer making money. There's been a big move lower in the dollar, right? I mean, the dollar has now dropped from, let's say, the summer or spring highs down to now about 5%, right? That's a big move on top of tech stocks no longer going up as an aggregate, right? Like the semiconductor stocks are the same level they were in April. So since April, for the most part, these investors have probably lost money, right? A, with the dollar getting weaker, and B, tech stocks no longer going higher. At some point, if the dollar doesn't recover, these people are going to be pretty prone to start cutting their holdings of these big tech stocks. And I'm just trying to get people to start thinking a little bit more global than just, look at your favorite tech stocks in a 5-minute chart. And there's something to that, right? That's for day trading. And you God know we do that, right? We do that. We have the TSD trender, we do all that. But from a portfolio perspective, there's so many things here that I think have to be considered that are, if we don't at least think about it, for 5 minutes a week and be aware that there are risks underneath the market, we get very complacent, not from a trading perspective, it's less important, but from our nest egg. Okay, so if there's any questions on that, let me just quickly pause here just for 1 minute, and then I'm going to go over one stock that I think is really interesting here. It's Uber, ticker symbol UBER, and I want to quickly walk you through this one here in just 1 second, but I want to give you an opportunity to see if there's any questions. Silver and gold, well, they sold off in tandem yesterday, right? It's an initial reaction. I wouldn't read anything into it. When silver, although, by the way, is extremely volatile, so if you're trying to day trade that, good luck. I wouldn't touch that with a 30-foot pole. Those are investment time horizons, right? So we like silver, but that's an investment time horizon of, at least 3-4 quarters, and beyond that, probably about, 2 to 5 years. So I'm not watching that necessarily intraday, particularly in a Fed day. But fair question, of course, right? Mike looks like he's got his audio figured out, so that's good. So let's talk about Uber then quickly. So again, the broader equity market melting up this morning, as we said before, and let's have a look at Uber. So when I look at stocks here that could have the potential for a little bit of a bounce, that actually are technically sound, I look at something like Uber, which I think we can all agree and we can all draw some very simple lines around that could actually move higher here from a trading perspective. So we look at something like Uber here. Again, the ticker symbol is UBER. And we notice that this stock has and again, this is where a lot of people start getting excited because we can doodle on the chart. And so what we can do here is we can draw some inverse head and shoulders patterns, and we can, we could even put a smiley on around that if we want to. So we can do all these things, and it would be right? I mean, this is absolutely is an inverse head and shoulders pattern, and the solution here would be for the stock to move higher, right? And where would it possibly go? Well, from this point on, and I would imagine this stock is probably up in pre-market, it's probably, the recent highs there at 82. So maybe that's the next level where this stock could go to. I was looking at the earnings data. Let me just quickly remind myself. What was that here? Uber. Here we go. So Uber has its next earnings report not until November, so there's time there. So this is one stock that, from a pure trading perspective, looks interesting to me. But again, that's a pure trade. That's about all there's to that. But again, that could be about 10% higher from here. Maybe one looks at the options market and looks at an at-the-money call or a call spread, probably even better. So that's one thing I like. I will, however, I'm going to end this here because we're almost 50 minutes into it. I do want to warn people that the things I mentioned before, right? Be aware that all we're seeing here with the equity market being up, it's essentially just the dollar getting blasted, like our purchasing power being eroded. So when that happens, the equity market goes up, right? That's kind of what we're looking at here right now. Okay, so we'll keep it to 15 minutes, folks. I'm gonna leave it at this. I don't want to go much longer because we've now found out after a week that people like the 15-minute mark, and we are going to be back here on Monday, this coming Monday. Do you have any thoughts on FedEx? Not really. I don't. I think I can see what you're referring to there. I have no view on it. I'd be careful on a transport like that at this point from an investing perspective, personally. From a trading perspective, I think it's going to react along with the broader market. That would be my general thought on that. But if you're getting bullish now this morning, I'd be careful. Just understand we have Bank of Japan tomorrow, and seasonality wise heading into this U.S. election cycle that's still very tight. I'm not quite sure, at least according to the polls, I'm not quite sure risk on is really the high probability trade. But if you guys enjoy this, hit the like button. If you have any suggestions how we could do things better and different, let us know. We're just getting started, right? We've only been here now for a week, but we're going to try to keep it to sort of this 15-minute mark. Typically, because otherwise, again, we've noticed that people tend to lose interest after 15 minutes. That's the whole point. It's a quick 15 minutes, some of our top thoughts. And we'll be back here on Monday. Hope it was helpful. Thumbs up if you liked it. And we'll see you guys again next Monday when we're back at it for a new week. And again, don't get too bullish here this morning. That would be my personal view. That's not advice, of course, just through the lens of education. But let's see how the next few days shake out and then into next week. Take care. Thanks for being here.